Yeah, with the not just actually metals traders, but it strikes me, Scarlett, as I look back, it's probably been one of the best years for metals, most notably precious metals, since 1979. And I bet most
Wow.
of these traders weren't even born then. So it's good to be on the right side of the trade. But what you're seeing happening is a lot of commodity traders are just tilting over to what's moving and moving a lot. Gold's leading everything, platinum, silver, and palladium all catching up. Copper's kind of stuck in the middle, but it's the metals are where it's at because crude oil, the grains, most other commodities are heading lower. And the bottom line is people are trading a little bit for the debasement trade. The key thing I want to point out is once it hits the tape, like what we're talking about now, it's usually a sign it's pretty excessive. And I like to point out, I'll end with this, the 40, 50, and 60-month moving averages, if you take gold versus those levels, it's the highest since 1991. So people like Tom Keene would say it's like the sixth standard deviation against those levels. It's very expensive.
So, I mean, as it relates to these metals, is it a momentum trade here, do you think, particularly for these precious metals, Mike?
Oh, certainly it's pile on now. The key thing is central banks have been the biggest buyers the last few years, but they're a little more elastic. I don't think they're going out of the way to buy here. ETFs have been the key significant thing this year. We have a total inflows in ETFs this year approaching 20% of the amount of ounces into ETFs. And that's significant, Paul, because the last 4 years there have been outflows. So people are flowing in. But I just pointed out once gold gets this expensive and becomes this popular, it's really, really kind of, you got to be careful. It's not the place to pile in. In fact, the essence of the business is being able to take profits, particularly if you've been overweight long. But the key thing, it absolutely scares me when virtually all risk assets, particularly Bitcoin, the stock market, and all these high volatility assets underperform the rock. It's not a good sign.
Not a good sign. I know. The great lines here, Mike McGlone.
Those are the lines that traders have. That's what Mike's got.
And that's what he's going to be discussing, I'm sure, at the Money Show as well. Mike, let's talk about the debasement trade, because I feel like 2 weeks ago, that was all anyone wanted to talk about, this de-dollarizing effort to get away from the U.S. dollar, to de-risk portfolios. You're seeing gold hold up. It's a little bit weaker at the moment, but Bitcoin has not found its footing just quite. What's going on there?
Well, I appreciate you going there, Scarlett, because I'm very concerned about Bitcoin. The key thing to remember about precious metals, I mentioned there's four. There is only four major precious metals. In cryptocurrencies, there was one in 2009, Bitcoin. Now there's about 25 million listed on coinmarketcap.com. And I think all this narrative of this space being a debasement trade is kind of people are finding out it's not. It's a risk-on trade, and we're finding out that with the VIX going up, Bitcoin goes down. It's a direct correlation. The thing is, I think the best days of appreciation, the Bitcoin kicked in when it reached 100,000. That's now support. And key thing I really like to watch is the Bitcoin to gold ratio. Right now, it's about 25 ounces of gold per one Bitcoin. That's bottoming. It's holding at a support level that's very similar to the 10-year note at 4%. You see the connection? If it breaks below that level, which I think it will, it means everything kind of heads towards a more of a deflationary type trend, which is normal after significant inflation. So I'm not a fan of the debasement trade. In fact, I think gold's expensive, Bitcoin's expensive, and the only thing that's really cheap against a lot of these things are treasury bonds.